All right. Good morning, everybody. So I want to start out with our morning analysis by taking a look at what happened around the world. A good resource for this is Finance Juice. They have a thing called Market Wrap, and you can find this on our own markets, and then you can find it on the Asian market. And when we get up in the morning, you can find it on the European market. It's just a quick summary what happened in the overnight hours or what happened during that trading day. One of the reasons that I mentioned that it does our trading day is a lot of times we'll see a move in the market and not quite know what caused that move. And I personally, I like to know why. I want to know, hey, what happened today? Why'd the market move like that? And if I can't find it, I come to Market Watch after the market is closed and I look to see if they have any information about why the market happened to do a particular thing that day. Um, this is also a good spot to find out who's chipping their teeth this morning or who may be talking. We can see, for an example, right now, Bostic is out. He is having a meeting, and whatever he's talking about is showing up in here. All right. So on the left sidebar, it has a list of economic events for the day. And if there's going to be any scheduled speakers, you'll see them in there as well. Now, you don't have to have a paid account, but I do recommend that you have at least the free account because there's a lot of different aggregate news sources that are put in here and they're not all equal, right? Some news sources are kind of fluffy and they're just taking up space. If you have at least a free account, you can use the filter and eliminate those news sources that you're not interested in. Next, we come into Market Watch. You always want to look at least two different places to see what economic agenda is on the table today. Keep in mind that even now that we've seen two lists, by no stretch of the imagination have we got a clear picture of everything. There are a lot of Forex economic events that do not show up in a regular list. There's a lot of commodity events that don't show up. Boats that are leaving a dock, boats that are arriving at a dock, how much grain, corn, whatever. So there's a lot of economic data out there each day. This is one of the reasons that we pay attention to the quarter hour and the half hour and the full hour. Think about the government, this big bureaucratic machine that's just doing its thing. We can't keep track of every single announcement that might come out. But the government's not going to come out with an odd time frame, right? It's not like at 8:23 in the morning they're going to come out with a report, right? So even if we don't know necessarily when every report is scheduled or what that report might be, especially some of the more obscure ones like commodities, we can still recognize that there is the potential for increased volume and volatility within the market hourly, half hour, quarter hour. Just provides a little bit of insight, right? So today it's all about the GDP. The market, since the Fed has spoke, seems to believe the Fed is ready to pivot and or ready to pause, and their uh, bullish response is due to that. So at this point, bad news is good news, good news is good news, and everybody and everything is just ripping. We're getting that rotation. There's kind of a few different ways to look at all of this with the bigger picture. One would be interest rates and inflation, earnings numbers, peak valuations, liquidity. We're not going to get back to where we were. And when the market finally decides that we're not going to get to our uh, target rates, and they just shrug and say, whatever, companies are still doing good, earnings are still up, profits are still up, there's edge in here, I can still get trades, they're just going to go right back into trading again. There's also historical precedent that shows when the Fed talks about raising rates, the markets generally go down. But once the Fed actually does start raising rates, the markets tend to go up. There's a hard argument to be made right now about if the low is in or not. The GDP numbers today are supposed to, quote, qualify us as being in a recession or not, depending on whose technical analysis you subscribe to. Over in Europe, two lowered GDP reports would put Europe on a classified recession. In America, it's not true. That's not the classification. It doesn't really matter though, right? Whether you get that rubber stamp or not. Between now and September, it's going to be a lot of focus on earnings estimates, outcomes. The Fed left the door open for them to um, hit us with surprise rates. And they also have removed their obligation to provide insight or forward guidance, which is why everybody seems to have uh, interpreted that stance as being dovish, that the Fed is um, ready to pause now and or begin to pivot by around the first of the year. And when the market figures out that the Fed was not dovish and that they are not ready to pivot and they're not ready to pause, a lot of this is probably going to unwind. But until then, all of the fund flows are just pure bullish. And, you know, at some point, you don't trade sentiment, you trade what you have on the chart. Today's economic events: 8:30, 9:45, 10 o'clock, and 1 o'clock. I gotta say that the rig count, even with the energy situation that we've got going on right now, the rig count is probably not going to cause much volatility within the market. I worked on those rigs for 20 years, and I can tell you it's not going to make a big drop in things if we go from 176 rigs to 182 rigs, or from 176 down to 172, right? We drop 4 or 5 rigs off of that list, not going to make a big deal. Now, having said that, I've seen that list go from, say, 85 to 195 in one report. When you get that kind of change, you do tend to see a little bit of volatility in the market, but that's a rare thing. And we've already brought a lot of our rigs back online. Those rigs are 5-man crews, run 12 hours at a time, and they run 24 hours a day. They don't stop, right? So each rig is another 20 rig hands plus your ancillary uh, people, and it creates jobs and it puts people to work, and yes, and great, right? But most of those rigs aren't exploratory rigs. They're just going in and punching another hole, aiming for some big underground lake that already has 50 other straws poked into it, and they're just adding another straw to the same lake, right? So there's a bottleneck at refining right now. It's not the idea that we don't have what we need. It's the idea that we can't refine it at a cost and get it out quick enough, right? Reserves, things like that. So this rig count, I would never say just ignore a bit of data. And I always say watch the clock, be prepared at 1, but I wouldn't abandon positions that I'm in just because we're coming up into 1 o'clock. Not today. I missed the morning briefing yesterday. We had some pretty rough storms here. It knocked the power out. My internet company was down, and I've got COVID. So I wasn't feeling like going mobile and getting everything set up to be able to run it from like cell tower style. So there just wasn't one. All right, looking at the cumulative volume, we can see that we're not out of line. We're not in an elevated volume. We've still got obviously another, nearly 2 hours before the market, so we could pick up some more volume like we did yesterday before the open. But we're pretty much in line, a typical average volume, and that's all we really want to look at, right? Is it extraordinary volume or not? And no, nothing really stands out this morning on the volume. Take our chart back, get rid of that. We have an MDP this morning. That's a missed daily pivot. It's a trade strategy. If you haven't heard of it before, it's worth looking into. It's a reasonably decent swing concept. At the very least, it's an analysis of the market that involves a higher time frame. MDP, missed daily pivot. Right now we are in one. We're up nearly 0.5% in the ES, and we've got a Globex high at the COG line, 41.11. Well, yesterday's high, I should say, not the Globex high. 41.11, that's the COG line. We have an ADR of 1.9%. Half of that would be 41.44, and a full ADR would be 41.83. There is a market maker move today. These show up when your front volatility is greater than the back volatility. And the volatility that I'm referring to comes from the options chain here between the front volatility and the back volatility. And you can see 18.5 is greater than 14.9. That's why we have a market maker move right now. There's no reason for you to disagree with me or say that you've heard it means something else. I don't care. Somebody lied to you or they didn't know what the hell they were talking about. If you want to learn more about market maker move, go to the place that made the market maker move, TD Ameritrade. They have a publication called The Ticker Tape. You can Google that, search for the market maker move, and they have about 50 articles that not only explain what it is, but how you can use it. So if we take that additional 55 half of a percent and we add it to the 1.9% from our ADR, then we're looking at a market that could move pretty close, just using some rounding numbers here, about 2.5%, and it would not be considered extreme. So from where we opened in Globex last night, throw a 2.5% move to the upside. And that gets us very close to the 4211 cog line. I had to reach a little bit to get there, but it's pretty darn close. And it's COG, center of gravity. So if we get close, we're likely to get it. For a downside breakout, we would first need to break our own Globex low, break through the daily pivot point, break through the pivot minor around 40.58, break through the institutional pivot point from Wednesday, go through the ADR half, the cash open of yesterday, the full ADR, the previous week's high, and the Globex open of yesterday, the Globex low of yesterday, and the low of yesterday, just to get to a bottom side breakout. That's a lot of junk in the way. Now, we never want to use words like the market can't do this, or, imply in some way that the market can't do something. So while I won't say we can't have a bottom side breakout today, I am willing to say that I find it very, very improbable that we'll have a bottom side breakout today. Now, I've been doing these morning briefings for you guys well over a year now, and I have more than once used the phrase, I find it very improbable. And then later in that same day, the improbable happened. We are in a high volatility market environment. So, when they say 8 out of 10 times that something should happen, well, we're in that other 2% right now. That's the kind of market that we're in. So while it may be a very rare or a low probability that we break out of the bottom of yesterday's range, it is possible. It absolutely is possible. But we'll say that that's the least likely scenario. Now, with Apple and Amazon easily stepping over the lowered bar for their earnings yesterday, and we had that little exuberance and that pop, I look at the market this morning and wonder, where did all that exuberance go? Where's all the hype and the happiness and the trader willing to put capital on the line? Because I'm not really seeing it. The base case is that we hold the line. So yesterday's low to yesterday's high with every one of those pivot points that I mentioned in the middle. The best way to approach such a very large range day is to break that day down into zones. So zones or quadrants, yesterday's high to our own Globex low, that would be one quadrant or one zone that I would focus on. It has your VWAP in it, your Globex open, and then the high and the low, and our own Globex high of today. So you would have all of those pivot points. You could also add the 5-minute open range from the Globex. You could add the IB, which is initial balance. It's a 1-hour open range. You could put that into there, and that would give you plenty of tradable pivot points within this defined range of, call it 40.91 to 41.11, to that cog line up there. Should we leave that quadrant to the downside, then I would focus on the daily pivot point. That's a floor pivot, by the way. So open, high, low divided by 3. Or maybe it's open, high, low, close divided by 4. I'd have to go in and check. It's just the default Thinkorswim pivot point. So it'd be from Globex low to the pivot point. There's not going to be a lot of internals that we could use, not a lot of pivot miners that we could work with. So we would want to measure this range, the first range that we were talking about, and break that down into at least a 50%. And of course, if you notice, the 100% of the range comes very close to the daily pivot point. That would at least give you pivot miners from a measured move. Right, so the next quadrant would be from that daily pivot point past the ADR half to the institutional pivot point from Wednesday, which is Wednesday's high. Within that, we've got a pivot miner at 40.58. From Wednesday's high down to either the cash open or the bottom of the 5-minute open range. I would really consider either one of them to be valid. I don't think you'd have to really squabble about it too much. The thing about the open from Thursday is it lines up with a cog line at 40.31. I mean, they're so close together, they're almost overlapping. And that gives me a belief that there's absolutely going to be a reaction if the market was to come down and hit that level. Right? So while I wouldn't want a quadrant that small from 40.42 down to 40.31, I would certainly keep that level marked out, right? Be ready to adjust or deal with it. So the quadrant that I would deal with would be from the previous week's high to the Wednesday high, which is from 40.42 down to 40.16. And then from that down to yesterday's low. So as you can see, since it was such a wide day, breaking it down into these various quadrants still gives us control of the trading day from one structured pivot zone or area to the next. Right now we're looking at a daily chart of the S&P, and we have the weekly expected move here with the green and the red lines, and I just drew a box of around our expected move for the week. As you can see, we've expanded beyond the expected move. Now there's a couple of things about this expansion. It's Friday, got to keep in mind, I just said it's Friday, but honestly, being as sick as I am, I actually have to check. Okay, it's Friday. Keep in mind that the typical hedging that we would see when we break out of the expected move would end today. So while the market makers generally will buy into buying when we get at least one ADR away or one SD away from the expected move, it won't do that today, right? You won't see buying into strength or selling into weakness on the last day. Plus, we didn't quite go far enough, right? There'd be something else that would be on there. The next thing is, since it's Friday, look at next week's box, look at this week's box, and see what they did with the volatility. Did they increase the volatility? Did they decrease the volatility? And is it a substantial or a drastic amount? And we can see when I carried that box over and set it onto the next week's weekly expected move, it doesn't line up perfect, but it's pretty darn close. So no real change in market dynamics and market structures within the volatility system for the S&P. If there was a extreme difference between these two, then we would have a little more to work with. Remember that we're talking about a static expected move, right? This is one that once it gets locked this Friday at the end of the day, that's it. It won't move again. If you want a dynamic expected move, one that is constantly updating, then you want to come into the options chain and look at the uh, average implied volatility expected move. All right, we got a 10-day, 30-minute chart. We have a volume node beginning to build around 4073. So if we were to break our Globex low and begin moving in that direction, we could expect or anticipate a minor bit of support around that level. And that's it. We get through that and we're headed to the value area high, 4042. Below that, we have that weekly pivot, or excuse me, the previous week's high, and our point of control, which is 3954. That's a long ways off, right? It's very, very likely that we're not going to go down and interact with our point of control today. Hey, Ken. Happy Friday, buddy. It's worth noting how narrow the volume profile is here and how shallow the profile is. And that makes sense because we moved through this zone relatively fast, right? Well, what happens when you move through a zone really fast is you leave a, a volume vacuum behind, right? Liquidity vacuum. And while we don't see this as a gap, it often plays like one or trades like one that we end up retracing through, kind of quote, closing the gap first before continuing on. If you think about the way the market responded with the Fed, and then it tried to close that gap before moving on. The TPO and the volume profile are lined up really nice with their points of control. The TPO has a lower value area low, but not by much. We've got an untouched point of control that we could add to those pivot points that we were talking about. It's yesterday's point of control, right? And then the one before that, Thursday's point of control. So both of those are untouched points of control that we would want to carry forward. Those should be plotted out and they should stay on your chart until they are resolved, right? That's carrying forward that technical analysis. And the way I like to do it with Thinkorswim is when I do a technical analysis, you can save them to different layers, right? And that way you can turn those drawing layers on and off. So you can see the drawings when you want to see them and then get them out of the way when you don't want to see them. Takes a little practice before you get to the point where you're not accidentally deleting your lines all the time. I still do that, by the way. One thing that you can do if you're concerned about that is once you've performed a technical analysis on your drawing layer and you have it saved, share your chart, take that shared chart link and put it in your scratch pad with your notes, right? And then if you want to bring that chart back with all of its drawings that maybe you accidentally deleted all your drawings, you can just import that chart right back right off of your scratchpad list. Might It might just save you from having to rebuild, a good 30, 40 minutes worth of work. We are coming up near that 4,200 soon. There is I think it's a JP Morgan spread up around that level. So, in the options side of things, there's some serious resistance at that 42. Not to mention, the major pivot point from back here in early late May. So the idea that we get above 42, I mean, I think I'd have to do a full video to kind of stretch that out, but I don't really see it. Right? Let's just say it that way. So some of the things you're going to want to keep track of is the 10-year yield, that 210 spread. Watch gold. Continue to look for gold to flip and roll. Gold likes the reaction in them short-term rates. We're already seeing Bitcoin start to come off a little bit. It didn't get above that 25. Bonds are still backing off. That was a significant move yesterday, and we're still trying to kind of close that gap. The cyan line there at 142.11, that's the 4-period daily moving average. Think of it as a surge indicator. When we break through it to the upside, it's usually a momentum play. And how far we expand beyond it, how long we stay beyond it, is a part of that metric. So the bonds crossed it yesterday, had a large expansion beyond it, but came back and retested it this morning. It held on first touch. It's not likely to continue to hold if we keep kicking it. The dollar is still holding above 105. We want to see that dollar get below 105 if we're going to continue to see a push in the ES, especially if you want to get to 4,200 or beyond 4,200. We're going to need that dollar to continue to fade off. We were fading well earlier. We had an inside day breakout, but we're back inside, and we're going to retest a pivot point soon. There's been a few times in the last few days where the VIX futures actually were ahead of everything else. Now, the VIX this year has been an absolute turd. And, I'm the first one to point out when volatility isn't helpful or useful. Normally it is, but this year it hasn't been very useful. It hasn't been very helpful. But in the last few days, there's been a few times where suddenly the VIX futures start to drop like a freaking brick in water. And within 3 to 5 minutes, the ES and the NASDAQ begin to push to the upside. Now, generally, that's not the way things work. The VIX responds to the ES and the NASDAQ moving. The VIX doesn't cause the ES and the NASDAQ to move. And even in this situation where I'm saying that the VIX is moving first and the other two are catching up, it's not causing them to move. They're dumping the VIX and using that freed up cash to trade into the ES and the NASDAQ. Right? It's like a rebalancing or a redistribution. And right now, There's a whole lot going on when it comes to redistribution and funds that have to buy or have to sell. They don't get to choose to do this, they have to do it. If you want to read more about those kind of funds, they're called VC funds, volatility controlled funds, right? And they don't get to choose when to do this. It's just what they have to do. The thing is about a lot of those funds, they're trading insurance products and fixed rates, and they're not necessarily trading Apple or Google or things like that, right? But when a fund has to hedge, when they're trying to get back to, say, a delta neutral, and it's the same logic about buying into buying, buying into strength, and selling and selling into weakness, they have to do that too. And it's based on getting back to delta neutral. And one product that they will use to get back to delta neutral are the futures, because the futures have a hard delta. So, it's been responding that way. I've certainly been watching it a little more closely because of that. And, I want to mention it so you guys can watch it through the day. Maybe you'll see it through the day today, maybe not. I've seen it maybe a half a dozen times this week where it's responded first and then the ES and NASDAQ followed behind it. So, it's not happening constantly. Certainly something you would want to keep your eye on, right? Because it's just one more tool. You don't have to make a trading decision based on it. But when you're looking at the VIX and it suddenly starts to drop like this, big red dropping candles, I mean, what do you think's about to happen? And follow it up with the ES and the NASDAQ. What did happen? Oh, that nice expansion off of the lows. Yeah. Yeah. I like it. Right? You like it. It's a little concern about oil failing to fade off of that $100 range. We're not above that $100 range, but we keep coming up to it. We keep kicking it. We keep testing it. Really want to see that oil back away. So we're looking for a US dollar pullback. We're looking for a yen bounce. With the 10-year pulled back, we're expecting oil to continue to go sideways. Keep your eye on those real yields, see how much they're declining. We're likely not going to see that bounce in oil until after the bonds make their move. If we can get a move in the bonds, say they get a bounce first, then they drop, we start to see that rise in oil. And keep in mind, we had some big oil names reporting today too, and their numbers were impressive. Let's just say it that way. So I'm going to read something to you. Uh, I did not write, but I really want to share. This is a this is data dependent, and what it really means. When Powell said we are now at levels broadly in line with our estimates of neutral interest rates, and after front loading our hiking cycle until now, we will be much more data dependent going forward. The neutral rate is the prevailing rate at which the economy delivers its potential GDP growth rate without overheating or excessively cooling down. With this 75 basis point hike, Powell told us the Fed just reached its estimate of neutral rate, and from here, they aren't contributing to economic overheating anymore. But that also means that any hikes from here are going to put the Fed in actively restrictive territory. Good morning, Chewy. The bond market knows that every time the Fed became restrictive in the past, they ended up breaking something. Removing forward guidance would indicate a pause in the minds of market makers, and that's what we witnessed, right? Is the market considered that statement to be dovish and started buying. So he totally ditched forward guidance. And what happens when you do that? You give the markets the green light to freely design their own probability distributions across all asset classes without any anchor. And that explains the gigantic risk rally. The belief is that the bond market is pricing in a slowdown in inflation to hit the Fed target in the second half of 2023, which is very akin to markets pricing in inflation and growth collapsing, which caused real yields to decline, driving the risk on trade, NASDAQ, crypto, and rotation out of cash. So gradually, you can see the fractal of real yields and equity market valuations in a tight correlation. So, in a nutshell, given the bond market's strong opinion of inflation going forward and no autopilot Fed tightening anymore, within the horizon, investors went ahead and repriced all other asset classes accordingly. Here's the rub, though. The market isn't assuming that the Fed or central banks can fight the inflation beast. If the next inflation print is hot, the bond market will have to front run or react to that data, anticipating the Fed's reactive function. This will create more, not less, bond volatility, and we contend currency volatility and equity volatility. So a higher volatility in one of the biggest, most liquid markets in the world generally requires higher risk premia everywhere else. To sum it all up, the Fed can't and won't stop until the job is done. And the job will be done only when inflation has been killed, with likely big collateral damage inflicted to the labor market and the broad economy, too. Just wanted to share that with you guys because I think that was the most poignant and directly summarized perspective on this Fed announcement that I have come across since Wednesday afternoon. Right? I do a lot of reading because I'm a nerd, and that's what we do. And I thought that summary was just very well done. Right? And hopefully you got something out of it. I know it's hard to hear a thing being read and grasping it compared to reading it yourself. I can't share it with you. It's not a public document. It's the best I got. So what do we want to do with this thing, right? Isn't that what it all comes down to? How are we going to manage the day? And the big takeaway here for the day is if these GDP numbers surprise, the market is very likely going to start pricing that in, just like I spoke about. Now, I know that this is probably a little hard to see during a Zoom or a live stream like this, and I've shared this grid before. I will happily share it again. We're looking at volatility in a lot of different ways, right? So for those of you on YouTube, this is the grid that we're looking at. To explain it to everybody who's looking at it, we've got a 9-day VIX up here in the upper left, and then a regular VIX, which is actually just a 1-month VIX, and then a 3-month VIX. Then we have a 6-month VIX, and we have a 1-year VIX, right? So in order, we have all of those, and those 5, most platforms will have it. You just use the letter 9, and it'll offer you a 9-day VIX, and then your 1 month, 3 month, 6 month, 1 year. That's fine. We've got skew. From that, we've got VIX futures, and then we've got the move. Now, move is generically speaking, it's bond volatility, right? If the VIX is looking at S&P volatility, then move would be looking at bond volatility. And it also has had a significant move this month to the downside, off of some record levels, by the way. Then in the last column, we've got bonds and we've got the S&P. Still need to update my notes, but we'll get there. I'll get it put in a few days. You want to continue to keep your eye on the volatility out there. That skew is picking up. Probably want to take at least a casual glance at the VVIX. That would be the implied volatility, or it's how much volatility is in the VIX. So it's the volatility of the volatility index. Thought I had a chart for it, but I guess I don't. There he is. So the VVIX on the weekly chart. This is telling us the volatility is at, some extreme lows. Not at the lowest that we've ever been in history, obviously, but if you go back to you get 2022, 2021, 2020, there's the corona, there's where COVID, and we spiked. But look at the lows that we had before that, right? And you kind of remember how we left 2019 and came into 2020, and we were sitting at the highs and everybody was bullish, and we were running at a VVIX of about 88, and we're down to an 80. So we're at a lower level than we were pre-COVID. Does it feel like we're in a low volatility environment? No. Right? Like, spoiler alert, no. It doesn't feel like we're in a low volatility environment. But this is telling us that the VIX right now is not volatile, right? When you bring in Nerd Talk 101, volatility is another word for movement. So the VIX is recording movement. If you are looking at a candle chart rather than an implied volatility within the options chain, if you look at something like the SPX and you look at how far the market moves from one day to the next, they call it candle close to candle close. The distance between each candle close is how we gauge, quote, volatility, because it's movement. But that's where you get into what they call real volatility or historic volatility, right? It's the same word, same language. Again, it's volatility. Do these candles imply that we're in a low volatility environment? The scope and the pace and the size of these candles and the distance between each one of them. Looking at another way, does the expected move on a week to week basis imply in any way that we're in a low volatility environment? These boxes may not seem very big, right? We'll take the current box. This is the current week's implied volatility expected move. So I'm going to keep it that size. We'll just expand this chart out a little bit. Take that box, bring it down to pre-COVID levels. Look at the size of that box that I have, and look at the expected move that we had back then. Even the week before COVID kicked in. We're in twice the range on a week-to-week basis than we had back then. Volatility is high. When we think of volatility as the distance from candle close to candle close, when we think about the size and the scope and the pace of the movement between each day, look at something like your ATR. Pre-COVID, when we were running with an ATR of 19 and 20, or even down to 17, that's a 14-day ATR. It means they added up the last 14 days of movement, and they looked at the average range of movement from the high to a low, and we were running between, call it 18 and 25. Look at the current ATR right now, running anywhere between 100 and 75. Does it feel like we're in a low volatility environment? No. So when I say the VIX hasn't been a very useful tool and that it's basically been a big turd, this is kind of what I'm referring to. It's not very useful right now. It's not very helpful right now, and it's certainly not being reflected within our options. So proceed with caution if that VIX actually does start to pick up and function. And I've seen it a few times this week where it actually was front running, right? And of course, it doesn't front run. They dump the VIX that they're holding, and then they use that freed up capital. All right, so let's look at some stocks and call it a morning. I didn't share that chart with those of you in the chat. Sorry about that. Ah, darn it. Here's that chart for the VIX cluster. So the expectation is, as long as we're bullish, keep getting it bullish, right? But I just gotta stress, approach with caution. We don't just, buy all willy-nilly. And as much as your gut might say, oh, wow, we've gone so far in one direction, surely it's time to short these suckers. Don't instinctively just run out there and start shorting stuff. We want to see a reaction from those GDP numbers today. Um, that would be a good start. Watch the fund flows today. That might be a good opportunity in the later part of the afternoon for some swing trades to the short side. Um, or do what we've been doing a lot this year, which is just buy the naked call or buy the naked put. And when the trade isn't working out, sell against it like a calendar or a diagonal to cover that risk and get it paid off. And that way you're holding those long options for free because you've taken the time to pay off their risk. So we're looking at Amazon here. And of course, this is a daily chart that does not reflect that earnings. To be able to see it, we got to go into an intraday chart at this point. Last print is at 135.85. So we can just reach out there with the line and, kind of snap it up, come back out to the daily. You can see that we're right up in here, right? We've closed that gap nearly. When it comes to a gap close, there's two kind of arguments. There's those, wannabe Canadian engineers who think it has to go all the way up to exactly the closing point of that candle. Okay, I mean, at least you're staying consistent in what you do. And then there's, the rest of us who say, well, it hit the institutional pivot point on the day of the drop. It's close enough. I don't really have an argument on that either way. Doesn't to me, I don't care which way you want to do it. Just try to be consistent in your analysis, right? If you're going to use the close all the time. So with that in mind, the close would be 138.2 or give or take, be at the bottom of that weekly expected move from that week's range. But it also means that Amazon now has a very strong support level underneath it at 130. And that may be worth thinking about when it comes to, could we do like an iron condor or maybe a broken wing butterfly or something like that? Right? Yeah. Yeah. So a pretty big move. They had a very low bar and they were able to step across that bar pretty easy. Right. Apple is another one that's not being reflected within the daily chart. We need to go into the intraday to be able to mark that earnings move. Just snap it where it is currently, and we come back out to the daily. A little tip: if you're using Thinkorswim and you're on the daily, it's pre-market. If you're in this kind of situation, one thing that you can do is just look up here, look at what the current bid ask is, and then just draw your line there. Right? You don't have to go into the intraday the way I do it, but I want to snap my line on that candle, so I tend to do it that way. Right? Either way, so that's at 161. Um, that would be a topside breakout after this wedge that I have drawn here. And there's no, the next level of resistance is around 165. So a few more dollars up beyond that. If we think about where it hit and then pulled back, I would mark that peak because right now that's going to be the resistance we're going to have to deal with at 164. Tesla responded nicely to the move. We're not yet out of that gap at 865. So that's the overhead resistance. A lot of these charts are going to be presenting us with this opportunity, right? The main thing, though, is we've got to get through that Globex high that's now over our head. That's going to be the situation that has to be resolved. And it's not just in Tesla. I mean, we're talking, look at the ES and the NASDAQ and everything else. We set that high print last night, and now that high print is over our head and holding on to us, right? It's 8:30, so we should be getting those GDP numbers. Boom, boom, boom. I almost feel like I finally I finally reached a point where these morning briefings are, you know, reaching other people because I'm actually getting spammed now on YouTube. That's it's got to be a benchmark, right? When you've reached the level that you get spammed in a live stream, in a market live stream, no less. So in the monsters of tech, Amazon, Apple, Tesla, Microsoft, Google, that peak that we set last night with Amazon and Apple reporting, that peak is now going to be the absolute benchmark that we have to get through this morning. And if we're going to do one last pop hoorah before the dump, that peak is very likely going to be the rejection point. Thank you, Regina. I noticed that T-Mobile was on MarketSmith, and when I went in, this thing has been garnering a lot of institutional buying. And then, of course, it had this big breakout, which is why it was on the breakout list in MarketSmith. The institutional buying in this thing has just been absolutely insane. So, in a lot of these names, consider how many are not overly extremely expanded yet. For an example, Google. Yeah, we had a big move, right? No argument out of me. Google had a big move, but Google is sitting in the middle of the range. We're not at the high of the range. We're not at the low of the range. We're in the middle of the range. And it really hasn't made much of a move compared to some of the other names out there. Having said that, when you find a market like Google that is really big, it's really impactful within the market environment, it is often a leader within the monsters of tech, and it is dragging its feet, not participating in that move, that you might not want to look at this as, ooh, this one hasn't popped with its peers yet. Maybe I'll get in before it does, because it very likely won't, right? If it didn't when it should have, it's not because it didn't happen yet. It's probably because it's not gonna, right? So a little bit of concern there on Google, especially when you start thinking about how many names right now in the monsters of tech are not down significantly or drastically compared to their peers, right? You take something like PayPal or Netflix, right? And Baidu and Baba. When you look at that kind of beat down, and then you go back and look at something like Google, sure, Google's down a little, but not compared to something like this or Netflix. Kind of puts it into a little bit of perspective, yeah. So just approach with caution, guys. Let this week play out. I'm really interested in building in some new swings. I think between the 2 and 10 year yields, maybe the bonds, some gold. We got some plays out there. I just want to let this week play out, let it finish off, and next week come in and start working with what the Fed gave us. All right, consumer discretionary. Nice expansion from yesterday. Watch that resistance at 158. It's been a significant level of resistance. It shows we're above it here on the intraday. Shows we're up to 162, really. So now that line that I marked at 158 or 157, whatever, that's now going to be our support. If we break that, that'd be a great trade to the downside. If everything starts to crash and burn, that's a good start in the right direction. Energy, XLE. $77. Significant level of resistance. We didn't quite hit it. We're getting that fade off now. Notice how much we are gapped up above that previous day's candle. We can use the institutional pivot points off of that for our benchmarks back down. There's a year-to-date anchored VWAP. It's that white line. And that's basically 73, 75-ish, right in there. So very close to the interactions we would have today if we do get that breakdown. And I did mention it, but some of the big energy names had earnings this morning. So going to be looking at things like USO, XOP, XLE. It would also be worth looking into things like metals and mining. I know when I worked in the steel industry for about 10 years, there was, a very tight correlation between the energy market and the steel market. Looks like retail didn't like what we got this morning. Last print is 63.5, just doing some rounding. Which still shows that we're in a gap up from this previous candle. Why is it not showing on the daily like it normally would? Trend spider. So we're going to be looking for yesterday's high to be a pivot point, and should that fail, then we would focus on yesterday's close. That'd be 63.22 and down from there. That would also put us back underneath the 50-period moving average. Chips are down more than 0.75% this morning. Be looking for a turnaround in that. I would not be looking for a turnaround in that anytime soon. The benchmark is going to be that 10-year moving, or excuse me, the 10-day moving average. It's the blue line here. When we expand too far away from the 10, we happen to often pull back and test it. Think of it like the center of that basketball court, right? Or the mean reversion, is the middle where everything expands from that. We are back above the 50 in semiconductors. We expanded, a considerable distance from the 10. We got the pullback happening now. See if it holds. If it doesn't, then we're still going to be focused on the 220 level and see if this previous pivot point, which happens to line up with that 50-period moving average, happens to provide us with any support. Emerging markets down 1% this morning. this is usually our risk on gauge. We look at emerging markets as global exuberance or lack of. Looking at the EV markets this morning, our legacy names like GM and Ford, they are up at least 0.5%, but Tesla's up 1%, Ride's up more than 1.25%. So, looking at the EV markets, some of these are looking pretty good. NIO is not one of those, and neither is Li Auto or XPEV. So I'd be interested in what the dichotomy is here and why we're seeing this significant difference between these two groups. Take a look at the crypto names. I think today, guys, is going to be energy and financials. I kind of thought that myself, GM, but until I got to my list that had like JD and Baba and Baidu, I wasn't going to say it for sure because I wanted to see those other names, but that's kind of what I thought. For those who aren't seeing the chat, GM said the XPEV and Neo and Li Auto, Chinese names. Makes perfect sense. We would back that up by looking at things like JD, Alibaba, Baidu, right? Let's see. We're looking at crypto here. This crypto list is companies that own a large amount of crypto or are heavily vested within blockchain itself. So it's not necessarily a list of coins. That's why we see things like Riot, Mara, NVIDIA, TSM, PayPal, and it seems to be a little bit of a mixed bag. The chip names not looking so hot in there, and yet names like Square and PayPal doing much better. And the pot stocks, not really looking all that good today. A couple of names in there. So, guys, it's very likely going to be the same that it has been. Energy and finance. Energy and finance, they've got liquid options, some pretty cheap companies overall, great liquidity, nice charts, lots of movement. They've been the trades that's been working most this year, or at least the sectors in the industry that's been easiest to focus on for like day trading and things like that. I don't think today is going to be any different. I definitely want to stress caution when it comes to the idea that don't just run out there and try to short a bunch of stuff thinking that it's overextended. Right? Rallies in a bear market will get bigger and bigger the deeper we go, right? So the more the S&P falls on that yearly chart, when we rally, the bigger and bigger and bigger those rallies are going to get. It's still a bear market rally, right? So, just kind of approach that with caution. The rug pull could come at any time, but they can last longer than you could ever imagine. All right, so we can see some of these financials are really taking a beat down this morning, like Citi. Well, okay, well, Citi really stands out, but only Citi is taking that big of a beat down. Berkshire is a little soft. JP Morgan definitely feeling some of this. Bank of America. See, regional banks aren't really showing any of it at all. It's more of the XLF than the KRE. Looking at tech, yeah, that fade in PayPal, Nvidia. All right, so a couple of those energy names, MRO, it's about, it's less than a $50 company. It's pretty cheap. It's a good one to trade. We got that nice pop. If we fail to keep that breakout from yesterday, so it'd be an inside day breakout failure, this probably be a good chart to a good market to focus on today. If there is nothing else, right? We can always trade the indexes, but if that's our cup, we could be looking for a handle on that cup. Energy and finance, guys, is what I got for you. Be careful, be safe. It is my day to stream, so I'll be in stocks and options around 9:15.